Hello, everyone. Welcome to today's webinar, Practitioners Insights, Investing into India, a primer on offshore funds, hosted by CFA Institute and CFA Society, India. India is one of the fastest growing major economies and has always had the potential to become an attractive investment destination. While the potential has translated into impressive flows in terms of long-term foreign direct investments, short-term foreign institutional investor flows from offshore funds has been fickle and sensitive to macroeconomic factors, mainly the interest rate differential with the US. Today's webinar, Shamit Chokshi, CFA, will discuss the offshore funds, trends, investment objectives, fund structures, as well as his opinions on recent market developments. I would like to take a moment to welcome our audience from around the world joining us today. I'm Sivanand Ramachandran, CFA CAPM, Director of Capital Markets Policy at CFA Institute, and I will be the moderator for today's webinar. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A. We will spend about 30 to 35 minutes on presentation and last 15 minutes for Q&A. We will be leaving time for Q&A after the presentation. Please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. The webinar presentation should be available with the participants in a few days' time. We value your feedback, so please complete the evaluation survey before you sign off today. Now, it is my pleasure to introduce our speaker for today's webinar, Shamit Chokshi, CFA. Shamit is the head of offshore fund investments at ICICI Prudential AMC Limited. He is also the Director, Professional Learning Committee at the CFA Society, India. Shamit joined the AMC in February 2016. He oversees over $2.5 billion of assets advised across various funds and institutional mandates of global clients and leads manager selection for global strategies for local investors. He has more than 14 years of experience in manager selection, investments, research and advisory, products, asset raising, and global strategic partnerships. Shamit is a CFA charter holder. He leads the local research and advocacy subcommittee, and he also pursues advocacy efforts in ESG fund regulations and foreign investments in India. Over to you, Shamit, for your presentation.
Yeah, hi, thanks, Siva. And good evening, everybody. Thanks for taking the time out to get a sense of what's happening on offshore funds in India. And I'll just get going on a quick presentation deck. And after the presentation deck, obviously, I'll be very open to answer any question on offshore funds specific to India. So I think we can get going with the slide deck. So yeah, Indian equities are obviously, this is an interesting slide because, we always thought that offshore funds and foreign investors typically are the key sources of price discovery in our market. But I think one of the big structural shifts that's happened in recent years is the entry of very long-term investors from the domestic side of things. If you look at 2016, the EPFO, the local pension funds, started buying ETFs in India. And by 2017-18, we already saw a lot of SIP inflows happening into the market as well, almost $1 billion a month. So clearly, price discovery has shifted away from purely foreign investors. It is a function of both domestic and foreign investors now. A bit on where this money really comes from. So I think as public asset managers, we focus a lot on funds and sovereign funds and mandates. If you see these charts on the left-hand side, most of the money comes in through global emerging market portfolios and not just a typical single country fund that you might imagine locally in India. Also, if you look at the breakup of these fund structures, we can come to that at the later stage of this discussion. But out of the $600 billion of FPI money that is currently invested into equities in India. Almost, I would say, about $300 billion worth of money comes through regulated funds or trusts and those kind of sources. And I really like the fact that global emerging markets continues to dominate other kinds of products that are available for investors in the market. We'll come to that in a bit, and on how global GEM funds play a more meaningful role versus single country for many investors, and why people still don't have a dedicated allocation to India in many markets. This is a good snapshot of a standard FPI flow across the years, and it's very erratic, frankly. While we've seen structurally high flows coming into Indian markets over the years because of constant deregulation and better ownership criteria across sectors, what you do realize is that the US remains by far the largest foreign investor into India. And even though personally, I believe that most asset managers have made tremendous efforts in launching so many India funds in markets like Japan, Korea, Taiwan, or even Luxembourg and Europe, US continues to be the big supplier of capital into the markets. Maybe other markets are growing faster than the US in terms of fresh flows, but I frankly do not see any market as dominant as that. And FPI ownership remains, I would say, a bit in the middle right now. Generally, we've seen much higher ownership patterns of almost 23, 24% as well. We've seen a low of about 18% or 17% in recent months, but very volatile in the last few years. So not much can be made out of where the ownership pattern will go from here. But I believe that we're done with deregulation and most sectors are open up already. I think it requires a lot more gross flows to sort of change these numbers materially. A bit on the debt market, something much more exciting has happened in the last few years. And I'll have a couple of slides on these in the middle of the deck as well. In the last 10 years, we've seen a very low interest rate environment around the world, especially from 2010-11 onwards. And that's when Indian debt markets really became attractive to long-term investors. Until then, there were only proprietary investors coming in and sort of getting absolute returns out of government bonds or a few corporate credits that they used to finance or play with through their banks. But in the last few years, most asset managers have been significantly benefited by launching single country bond funds in various markets, because India was providing real returns in dollar terms, while the German bonds and even the Eurozone was close to 0%, while US was in a very low rate environment. Long-term pension funds, very large base of retail investors who are looking for sort of retiree or dividend yields products in their markets, they were investing into Indian bond products, typically yielding 8 to 9% when the rates were quite good, without hedge. They used to easily get about 4 to 5% dollar returns. And that was quite great for a retiree in Japan or somebody in Korea looking to match asset liability by about 2 or 2.5% in dollar terms. So clearly there was a huge opportunity. 2014, 15, in fact, many Japanese investors made double-digit returns on just AAA Indian bonds. So I think people really underestimate the potential of investment-grade bond portfolios, and currency plays a very big role here. But currency can also be to your advantage. It can be a good risk to have for many investors, depending on which market they're in. Again, this is a slide that you might have seen in most presentations as any professional investor or intermediary in the market in India as well. But the point I want to make from this slide is that Indian markets are very volatile. We seldom overestimate the growth story and sort of not look at the fact that the volatility that Indian markets display across market cycles simply does not, it makes it very difficult for us to not be called a risk asset. And that's where global emerging market managers are better able to optimize their portfolios, because their ability to invest across different emerging markets or even quickly allocate to developed markets out of emerging market portfolios makes them much more agile to manage market volatility. And that's why you also sometimes see decent flows coming in from domestic investors in a good growth story in a typical year, but you question why FIIs or FPIs are not investing, because frankly, most of the time we always see FPIs looking at the risk-reward relationship from a global macro perspective. So you will see periods where India is doing well, but you'll also see those years where developed markets is doing even better, or specific emerging markets are going through a significant breakout. So I think the ability of a foreign investor to have a larger universe of companies to invest across across the market universe makes them much more agile and able to optimize their portfolios compared to a single country India exposure. So I think we always fight that challenge as single country managers out of India. And at some point, I think emerging markets universe makes a lot more sense to me personally. Again, this is interesting. I like this slide very much. Typically, we talk a lot about the top sectors out here to investors, talking about how diversified India is as a market, and that possibly makes it also even more interesting, because not just diversity of the sectors, but also the scale of the market is huge. We are now a $3.5 trillion total market cap at some point. And if you compare India and China, the two big markets in this slide, you realize that as the market grows and becomes more, or if it's more diversified, the scope for single country funds goes up, because the number of single country funds we have for India and China compared to other interesting emerging markets. So I think when I talk about GEM funds versus India funds in the offshore space, typically the response is confusing from different parts of the world. But I think that as India continues to grow and ownership patterns continue to get more diluted away from promoters, you will see a lot more single country funds coming up. With scale and diversity and more sectors being added, India becomes a regional market in its own space. And this is the equities we are talking about. And we'll come to bonds, obviously, later on, because we've seen those news items also recently. But it's a slide that I really like to talk about when I speak to foreign clients. They appreciate the fact that it's not just a domestic consumption story, but it's also an export-oriented story. There's also a large number of global multinational companies listed in India, which makes it also a large manufacturing economy. So I think from that perspective, India definitely has its own advantages when it comes to marketing India funds globally. This slide is well known to most of us. We might be reading about it in most newspapers as well. But again, India tends to do very well across emerging market portfolios on a standalone basis. Yet it's very difficult to convince a global foreign investor to consider single country India funds, more from a risk perspective. We saw the volatility as well. But frankly, I think this chart only tells us one important point, that diversification helps. It's important to invest across a range of emerging markets, because risk attributes and sources of alpha can keep changing every year. It was a commodities and energy play in the last few years. It was consumption about 5 years back. And now we are going back to a more traditional market cycle where, interest rates play a very key role in deciding the cost of capital for most companies. So clearly, I'd say that India looks good on these charts always, but it's only the top line. Don't forget the volatility, and it's volatility that decides investment behavior in a very unique way. So whenever volatility is very high,
if I can just interrupt you and ask a question
sure.
about so one aspect is volatility, but the other aspect is correlation, right? So if you add a particular asset to your portfolio, your overall portfolio, you would want to see what is the incremental diversification in terms of correlation that provides, that could potentially enhance your overall risk return profile, right? So do you have do you know what's the kind of correlations India has with some of the other markets, and how it has changed, if I can ask that?
Yeah, so I think we don't really track India versus, let's say, a Philippines or a Malaysia. But we do track the correlations versus the US dollar quite a bit. When so for example, in this entire cycle of the dollar strengthening, an emerging markets portfolio typically would have been better placed to manage this crisis. For example, if you look at the Asia Pacific universe of companies, screen them for a correlation with dollar appreciation of, let's say, more than about 30%, and with dollar revenues of more than 15%. those companies have outperformed in the last in the recent cycle versus the rest of the companies. So that kind of correlation at an emerging markets level makes a lot more sense, because then you have more universe of companies. If you run the screen just for India, you possibly end up with just 2 or 3 stocks. But if you run it for an emerging markets portfolio, you will get easily a good screen of 40 to 50 companies from which you could select 15, 24 overweight positions. So I think similarly, when the tide turns, when the dollar strengthening possibly hopefully peaks out and the tide turns, you could see companies which are significantly exposed to the US dollar negatively also display significant outperformance. So you could do a negative screening as well, say that companies with, let's say, a debt to equity ratio of 30%, having a dollar debt or a foreign debt exposure of at least 15 to 20%, and a negative correlation of less than 15% with the dollar. Those companies could do extremely well should the dollar appreciation not hold true going forward. So I think that's the kind of correlation you would look at. It's more driven by factors that impact prices and not just between 2 markets.
Understood. Thank you.
Sure. I'll just keep going then. Again, this is a chart that we always put into any presentation, right? And in India versus crude, we might know it very obvious that crude prices hurt India, but trust me, they hurt really beyond a certain level. And typically, my assumption is about $80 a barrel is where most portfolio managers would get concerned about Indian markets, not just in India, but even FPIs. They are the first ones to, I would say they're better placed to predict crude prices, given that they manage global markets at a bigger scale. But the inverse relationship for me, I think it continues to work very well. It should work well in the near future as well. And it's a good way to sort of predict the potential flows that come in from FPIs, because rising crude prices has never been good for India, and the secondary effects also are very obvious. I won't get into the typical India story here, but the point here is that FPIs understand crude prices, they understand the impact on India, and they are the first ones who possibly would take a meaningful positive or negative positions given the crude price movement. So we must keep a tab on how crude and currency moves, because that can explain significant performance within the Nifty outside the stocks. So for macro managers, this one is a much easier way to allocate capital, especially passive investors, because that's how they allocate across markets. They would look at key factors impacting market returns and sentiments, and they would look at these charts and say, okay, we want to buy passive ETFs focused on India or another market that's benefiting from crude prices. So I think that's the way we many of the emerging market FPIs look at India as well. On a passive side, they're asset allocators, so they have significant power to bring in huge flows in short periods. Again, EM markets correlation with the dollar index and the Asian dollar index. I put this slide only because a lot of people want to see what's happening in recent times. Post-pandemic, you've seen emerging markets go through a collapse, while India has stood out to be some sort of an outlier, and we often question why. And I think it's quite visible in the ADXY index as well. And I spoke about how dollar appreciation and has benefited a few companies, but clearly impacted most businesses within emerging markets. So I think these charts are important to track as an FPI. I think I keep seeing the factor exposure of currencies play out, leverage play out. Time and again, every market cycle tells us only one thing, that rising rates, foreign companies or countries playing with foreign debt or highly levered with foreign debt tend to suffer more than countries with less leverage to foreign debt. Again, countries or companies which are exposed to dollar revenue tend to do much better in a rising dollar scenario, and vice versa. So, and they continue to work across cycles. And this is obviously true for companies that have a strong operating model and profits. I would exclude some of the recent tech sector kind of businesses from these kind of conclusions. But definitely, this is a good chart that we believe we talk to our FPIs, and they typically are always debating these ideas while considering markets like India within the emerging market space.
Just a clarification question. So DXY, what is that?
So DXY is a trade weighted value of the US dollar versus its major trading partners, and the ADXY is a composition of some of the trade weighted highly traded Asian currencies with the US dollar. It just gives you a sense of how strong a US dollar is impacting a specific market. It's a good analysis to do because you get to understand, is the US dollar really relevant to my market? People keep saying, you are decoupled from the dollar or the US economy, but frankly, you're never decoupled from the US dollar. So I think that's the point people should remember. And at least every FPI is very clear. Currencies, interest rates, and crude prices, they matter more from a top-down perspective.
Thank you.
Yeah. Interesting slide. I want to spend some time on this slide because if you're looking at forward-looking flows into India, since that's the crux of the discussion today, look at the overweight positions on the emerging market index for active funds from the screening list that I have. It's a pretty large list of emerging market funds and their allocations into India. So you see the overweight position at 2.3% traditionally, but look what's happened post-pandemic. India's relative weight in the emerging markets index has gone up to close to 14.5%, being the second largest component after China. The active exposure for India on an average across these funds is almost 2%. So we are talking of almost a 16.5% overall weight on India, which was earlier just about 11% if you look at the active weight on the long-term basis. So clearly, there has been a substantial overweight position on India in absolute terms and relative terms, I think. And that's one of the reasons why India is seeing so much of flows coming in from emerging market products. Single country funds, unfortunately, don't display this kind of euphoria. If you ask me, if you look at the UCITS or the funds domiciled in Europe, single country India equity funds investing into India, I think the numbers in the last few years are not so promising. We've seen market share gains between managers, but clearly absolute flows have not been so large. So clearly, it also works the other way around. If you're part of an emerging market portfolio, your benchmark weights are high. Fund managers tend to get anchored to benchmarks in some way for risk exposure to markets. So they'll say, okay, if India is 14%, I still do underweight and go 12, but 12 is a good number to have, right? If you're an if you're a recipient of Indian flows. And so I think that overweight, the increased weights of India in the benchmarks, end of the day, works in our favor. It doesn't matter whether it's a single country fund or an emerging market portfolio. I'd rather focus on an emerging market portfolio where he has an overweight view on India rather than a single country fund where you have the risk of losing all money should clients have a risk off on one market. An emerging markets manager obviously will maintain some weight in India irrespective. So I think very interesting slide. I don't know how the future will go, but I think some emerging markets obviously have been trading at way below long-term averages in recent months, but normalization should see some correction here. But still, there's a talk for, and remember, China is 22% now, and most pension funds are now carved out separate allocations to China. Most asset managers have separate strategic allocations to China. So maybe if Indian weights do edge up further, the case for more single country allocations only grows bigger. So I think we're in good times based on this slide, clearly. Well, this is continuation of what I spoke, but this is one slide that I see all the time, but I don't like it. And I've put it here only because it's tracked very closely by most asset managers, by most market analysts, and even on the business side of things, people track these flows. I don't learn much from these flows, frankly. When you release these flows every day of what domestic versus FIIs have done, this near-term data point doesn't reveal much, except for the fact that Indian markets earlier the price discovery was very much linked to foreign investors. That mechanism of price discovery is now being more reasonable. Domestic investors tend to sort of provide liquidity or sort of be the other side of the trade when FPIs are on an exodus. We saw it in the last 6 months as well. So I think I like the fact that we have more depth in the Indian markets. We have more long-term animals out there: pension funds, retirement funds, SIP flows. These are very long-term money. People don't redeem this money over 15 to 20 years. So I think India lacked those kind of investors earlier. Now we have it on the domestic side. Of course, foreign investors also comprise long-term retirement funds, but a large amount of money is institutionally advised. So asset managers can take sort of cyclical or decisions to move away from markets. But that volatility is now getting less with our local pension funds playing a much meaningful role in equities.
So Shamit, just a question about this slide and the previous slide. So the previous slide showed that the weights of India in EM, they had gone up significantly since October, like beginning of January 2021, right? So it had kind of gone up like extraordinarily fast, right? And clearly, even with the relative weights falling a little below long-term average, you would imagine that the flows should kind of reflect that in the last 1 year or so, but we have seen outflows, right? So, I mean, is there am I reading too much into these two particular charts, whereas the weights are going up, whereas the flows are?
So it's more of optics. So this is the relative overweight within an emerging market portfolio. But if you've seen an exodus from emerging markets altogether, the absolute outflows are going to happen from India as well, while India might be overweight in their positions. And definitely, right, currencies have gone through a stress test in the last 1 year. So that's the reason here.
Okay, sorry. that explains. Thank you.
Yeah. Okay. I mean, this is everyone's slide, right? There's no rocket science on this slide or nothing proprietary here. Just one point here is that this is important slide. If any one of you on this audience is sort of trying to sell India funds or trying to talk to clients globally, or if you're trying to understand, what are the typical charts you should start off with, I think these are the areas where we look at the long-term average valuations for India, the forward Ps, the market cap to GDP closer to 1 seems to be a peak out. That's the number we typically associate for US markets. And look at the bottom slide. The difference in India, unfortunately, has always been negative. The earnings yield minus the benchmark GSEC. Very rare that you see that going positive, but those are periods when you must have extreme optimism on equities. Otherwise, when this negative gap gets very large, maybe the level of pessimism only grows on valuations. Again, these are all backward-looking biases. And nobody knows the future from that perspective, but these are good indicators of broader markets. So if you're a passive investor, typically ETF investors, and the ETF is a large flow into India, by the way, right? So passive investors would look at these kind of metrics, saying that, okay, if the market is overvalued, let's just underweight that market in our portfolio and let's not buy the ETF into India. And I think these charts work well for them. They're beta allocators. They go by near-term valuation metrics, and they typically buy when the 10-year average, the markets are close to 10-year averages or below it, and they'll sell it when it's one standard deviation above. Definitely, they'll sell it. So I think these passive players are becoming larger and larger, and this kind of investing is only growing, especially in markets like US, where passive investing is now the way of life for even retail investors through their advisor network. So we need to be mindful that simple market valuation charts can also sort of inflict significant influence over major money decisions through the passive routes as well. So I think this slide only explains that.
So I'm sorry, Shamit, on the previous slide, one comment which you said, I thought like more that negative number at the bottom chart, more the optimism and valuations. Is that correct? So higher negative means too much optimism.
Yeah, so you can, it's a use of words, right? So if your earnings yield is way higher, so if there's a significant earnings yield coming versus the 10-year GSEC, you're better off going into equities, right, rather than putting the money into bonds. But obviously, if your earnings yield is negative, so obviously it means that your stock prices are significantly overpriced and you're better off being in bonds. But that's a relative concept. You wouldn't go away from equities even if it's negative, right? Because interest rates across the cycle may not capture the complete post-inflation yield, right? So I think, but if it's positive, significantly positive, let's say there are 1 or 2 years when the earnings yield is significantly positive, then you will say that, okay, I'm better off. There's a significant scope that equities are significantly underpriced. I mean, that's the way you should look at it. It's a relative concept. I wouldn't say that it's an absolute yes or no, but if the extremes are there, that's when you should be more convinced that you've reached the extremes of the last 15, 20 years on these numbers, then you can shift across asset classes.
Right. All right.
And this discussion came up in the pandemic in I think June and July 2020, when a lot of dividend yields of many companies went up through the roof, and people were questioning the idea of being in bonds versus equities. And while I can't share stocks, but obviously large universe of companies were available at significantly attractive yields.
Yeah. Okay.
Yeah. Yeah, so India has always been at a premium to emerging markets. A common question asked by foreign investors, and the common response that we give is it's the quality of earnings, quality of businesses, the scale of the country. A large number of multinational companies are listed in India, right? So the relative valuations of the overall benchmark and index also change significantly. A very unique market, right? We have so many large manufacturing consumer companies from around the world also listed for their India operations, very unlike we see in many other markets. At the same time, India is a mix of consumption, domestic and export-oriented economy as well from the services side. So I think those attributes and the diversity of the sectors that I mentioned earlier adds up to some sort of a premium versus the emerging markets. The premium is too large right now, but that's a function of market movements recently. But generally, investors have been okay with India being at a premium to EMs, given the quality of the potential growth in the economy as well. So I think that's okay. One should not look at that as a sense of overvaluation or something like that. Rather, it's as long as it's been consistent over a long-term basis, there's a reason behind it, and markets are pricing in some specific attributes of the economy. So I think this chart is interesting because the first time FPI investors ask us why India is so expensive versus the rest of emerging markets. And the common answer would be that India is overvalued, but that's not the case. India has always been at a premium to emerging markets. And if you speak to analysts from large sell-side shops or even on the buy side, you will hear a lot more granular reasoning as to why the quality of businesses and the economy is way too stronger fundamentally versus some of the smaller emerging markets. I was just moving a bit to bonds again, because everyone tracks equities a lot, and possibly a lot more than Siva and me as well. But I think this is interesting, right? I like to see the 1.6% ownership of government bonds. Mind you, it's a very large market. Indian government bond market goes into more than $1 trillion dollars or something. So I think the interesting part here is that, in the last 10 years, when the rates were zero, India also had significant quotas on foreigners buying Indian bonds. The quotas were put in place as a mechanism to check any volatility in the exchange rates and the fact that the currency was not fully convertible. Not that it is today either completely, but we are getting there. But this 1.6% was almost 4% sometime in 2010-12. Interestingly, what we saw from 2009-10 is the start of single country bond funds by FPIs. We didn't see too many of them earlier. As I mentioned in the initial slides, mostly banks used to do prop trading on Indian bonds or park overnight money into Indian bonds. But then long-term investors started coming in for yield, searching in for that yield that they need to pay for insurance companies or for retirement pools in many markets where the demography is not in favor. And ownership of bonds went up to 3 to 4%, and that's significant. There was very, very significant move, and then quotas got dismantled in the last 10 years. So a lot of asset managers like me or wherever we all got excited, and we launched many Indian bond funds in all parts of the world, and they were all unhedged, open-ended bond funds, and we said let's replicate what we do in mutual funds. And it worked very well. If you've been focused on government bonds and the sort of the top-rated strategies, I think that has worked around very well for most asset managers. A lot of money was raised from large economies around the world in single country bond funds. And mind you, India is not even part of the EM index, the benchmark one. So this has been a sort of a sunrise story, and this will only grow bigger going forward because the experience was so good for the last 10 years that people actually now see Indian bonds as a yield provider for long-term investors like insurance and retirement pools. So this is interesting. A lot of people don't focus on the fact that even after the currency risk, many markets tend to benefit from 7-8% yields. And somehow the diversification case here is even better than equities, because the correlation between two markets in bonds might be very different from equities. And India is sort of a credit positive economy going forward, being a growth market. So I definitely think this is an area where you'll see significant delta versus, let's say, if you had a case for why FPIs are buying equities. I think FPIs buying bonds would get much more exciting going forward.
Right. So, Shamit, since you mentioned, we are not part of bond indexes, but there are talks that it's probably coming soon, right? And what do you think? Will be the incremental impact of what's happening when that?
Yeah. So I think it's a news item right now, but it's getting louder and louder. We don't know what's going to come out of it. But if it happens, we're in for a structural shift in terms of flows into Indian bonds, definitely, because given the numbers that we had, there are two large benchmark indices, and if you look at the money invested passively in those indices, almost people are estimating some $30-40 billion one-time flow into India on the government bond side. That's huge. That can impact cost of capital in India favorably. That can reduce cost of borrowings essentially, and the risk-free rate as well. So it impacts everybody, not just the bond markets. And if India becomes a 10 or 12, 11% of the overall index, you're seeing a constant refinancing option available for government bonds every year, because they have to maintain those exposures in the benchmark indices. And that's just the passive side of things. I mean, if India is 10 to 11% of an EM index, fund managers who have anyways been having overweight positions on India, let's say 2 or 3% of the overall EM index, they may end up having 14 to 15% exposure to India on the bond side. So I think this is, again, it has its pros and cons. I wouldn't have a easy answer right now, but as long as the monetary policy and the risks of any capital flight are well managed, and as long as we see that we have strong reserves at our disposal, I think the risks are on the upside in terms of attracting more long-term bond capital money to fund government bonds or even corporate bonds as well. An area of development for most asset managers, definitely you will see a lot more action in this space. And I think one must also realize that bond investors are homogeneous, unlike equity investors. So you either have a good trade or you have a bad trade, right? So the risk is that if everybody believes emerging markets are not doing well, they possibly all will take decisions together. So and very homogeneous. So that's the risk you're dealing with bonds. And we'll see how it goes. I mean, let's be part of an index and not being part of one, right? So I think it's a great move, and definitely. You'll have significant structural impact on yields in India if the numbers that people are quoting come true.
Yep. Thank you.
Again, I mean, these are slides continuing on the bond part of things, and India is providing real returns, and it's something that's very important. More of FPI investors always look at returns from a dollar perspective, at least for institutional investors. Retail investors might look at returns from their currency perspective, but they know that that the rupee eventually will be converted back from a dollar. So I think as long as you can provide real returns, you have a chance of attracting these flows that we just discussed. The problem is, inflation is imported for India for most of the time, and that and hence, a lot of this gets reflected into the currency as well. So I think a lot of investors go unhedged on the Indian bonds. If you're a long-term investor, possibly you'll see a good rate cycle and make good real returns. But many smart investors do a lot of structured solutions around Indian bonds. Even today, we see a large amount of activity with banks around Asia and the Middle East, talking about leveraged absolute return strategies where typically they will just lever up based on the AAA bonds, get access to low cost of capital, and they'll buy these bonds and collateralize the product and end up with 7-8% returns on the US dollar basis. not very attractive in the recent couple of months, but typically that's how people like to play or sort of create opportunities on these kind of bonds. So as asset managers, we always see these opportunities playing out every few years. 2010-11 was a golden period for structured leverage bond portfolios. Maybe sometime again, but it's a very opportunistic trade, but a very large amount of money gets exchanged. So a typical bond portfolio would go into a few $100 million. And it all depends upon access to leverage, the swap rates for converting the floating borrowing cost into fixed, the currency movements, as well as the ratings of the bonds at that moment, and also the comfort of bankers to go ahead with these kind of arrangements on structured funds. So I think everybody who are out, I mean, a lot of people I believe are already completely involved in these kind of activities on the sales side or the investment banking side. But yeah, asset managers play a very big role here by creating the fund, investing in the bonds, having access to leverage, and then sort of holding on to those portfolios for 4 to 5 years, managing the swaps. So these are not very complicated funds. It's just that they have a lot of embedded risks and triggers for unknown events. What if the bond prices go down because of volatility? There are margins, and then you have to go back to investors. So I think I like these products, but at the same time, they're not suitable for retail clients. They're very high net worth, private banking kind of products, and but somehow you'll see more activity in this space as well, as Indian bonds are fairly liquid on the government bond side. The spreads are so low, the bid-ask spreads, that you will see significant interest on these structured solutions from foreign portfolio investors. This is just a slide for people who want to track Indian bonds. I think if you go on this NSDL site, earlier it was NSE or BSE, and you realize that this is the quota for FPIs to buy bonds in India. And yeah, it's highly underutilized today. But 2012, it was highly overutilized, and we used to pay a premium to buy these quotas. And recently, governments made a fully accessible route available as well. And that's because, the interesting concept that the central bank used to manage is that they used to disallow foreign investors from investing too much into short duration bonds, so less than 1 year residual maturities. The idea was to reduce the volatility on capital flows in India. But obviously, with the pandemic, some of the most aggressive measures had to be put in place. They have this fully accessible route where there are no limitations on the way you buy, how long you hold the bonds, what's the maturity. So I think that's been done to attract capital. Maybe the fully accessible route is an experiment as well, leading towards the EM index inclusion, because these bonds essentially have no terms and conditions around what they can buy or what they cannot. So I think the entire conversation could possibly lead us to this fully accessible route available for EM indexed portfolio investors. So unutilized limits are huge, but that's because the quotas have gone up significantly, and also rates have gone up in developed markets. So Siva, one thing I think I haven't mentioned here is what's the future here? I mean, we've seen a good 10-year decade of good rates in emerging markets like India giving yields, but frankly, with developed market rates going up, and should inflation cool down in the next 2 or 3 quarters, the real returns in developed markets could be tremendous. So there's always a risk of these long-term investors simply moving away to dollar-denominated assets. I told you about homogeneity of investors, and it's already happening. The 30-year time horizon investors, the pensions and retiree funds, they typically reallocate to highly liquid markets in the developed markets as well. And if you're getting a good 6-7% dollar return on the best bond securities in the world, there's always a risk whether money will actually flow out of emerging markets or not. So it's a question mark right now. Yeah. We have just been through one cycle. We now see this cycle where rates are again at reasonable levels in developed markets, and we don't know if investors will remain in markets like India. Foreign ownership, I spoke about that. If you just compare India to the rest of the world, I think it's foreign ownership of Indian bonds is tremendously low, and definitely India is the second largest market. I think in one of the slides I showed you, it's the second largest market in Asia in terms of government bonds. And it's a tragedy that foreign ownership has been so low in a market like India, while smaller markets tend to be better owned by foreigners. But that's also because India has a very strong domestic market. Financial institutions, HNIs, retail, mutual funds, some of the biggest buyers and holders of bonds. So I think a very deep fixed income market in India. It's advantage foreign investors here because you're a small owner of a large market. So if you have to liquidate holdings in a day or two, I don't see a reason for you to worry about, because 97% of the market is owned by domestic institutions and investors. So you're always on the other side of the trade most of the time. So I think that's one of the strengths that India provides right now to foreign clients, because ownership levels are significantly low for them, and they typically would be a counter trade to domestic clients. Yeah, there was a macro slide. I was trying hard not to put this one, but why would they look at Indian bonds? Typically, India stands out well on the macro front. I think what typically drags conversations with FPIs is that your fiscal policy, monetary policy, your liberalization policies, or discussions around geopolitical risks, or the crude prices and the currency risks. I think those are the factors that typically dominate discussions with foreign clients. Even though the macros look typically good relative to other emerging and Asian markets, the liquidity part of bonds is also important. And I think many other markets possibly have very well-developed corporate bond markets on the secondary market side of things. And maybe that's one reason why, even though despite India having strong macro charts versus those regions, we see less involvement of foreigners in those category of bonds. So yeah, definitely work in progress for India on the corporate bond market side in terms of a better secondary market. But at the same time, I think India has done its bit by opening up the quotas and allowing investors to come in across duration on the government bond side. So definitely, we are seeing a structural shift here. Maybe next 6 to 12 months, we can come back and check what happened with the recent news flow and whether it really led to a major shift in flows. At the same time, developed markets are back to reasonable rates. So this is the first time that's happening since 2008, or 9. So let's see how this cycle plays off for markets like India. I think I've covered this well. I'll possibly move ahead. And India has done very well versus emerging markets. And we love to tell investors that your experience in India is good as long as you are in highly liquid bonds, highly rated bonds, and have strong credit research. And government bonds and HDLs obviously are great areas to look for carry. The spreads between corporate bonds and GSECs sometimes is not much, so you're better off being part of a very large government bond market, which possibly FPIs are now able to buy even sitting outside with the new NDS platforms in place since a few years. So I think a lot of development activity done. It's now, I think, an opportunity for FPIs, and India has done well. So if you're part of the EM index, definitely we'll see a lot more focus on Indian bonds among FPIs. And that's an area of development even for everyone on this in the audience here. If they want to focus on specific asset classes, I think this area is still underrepresented by a lot of managers, institutions, and the scope for development is huge. I'm just taking a big step back, Siva, and going to a different topic on outbound investing. So, quickly, a lot of people have been asking about, we want to invest abroad, and the post-pandemic diversification conversation that's been floating around has led to so many foreign funds being launched here. So one thing I do here is we do select a lot of foreign funds or ETFs to invest into. And at some point, we realized that we need to have a very cohesive solution for clients. But what you see here on this chart is stark. I think most of the money is only into US markets. Even the global funds, significant portion of their AUM is into US markets. So very US-centric investment behavior, but that's logical. It's still the largest and the most liquid market in the world. And as a first step towards diversification, US markets seem to be the best way to approach that as well. But investors have been, they've been very momentum driven. A lot of money has gone into passive indices focused on technology. A lot of money has gone into traditional passive indices as well, but active managers have done well. I think what I like about this whole chart is that finally we see significant focus across our mutual fund market to diversify, to invest into global strategies or companies, businesses that are possibly not available in India, or sectors which are completely underrepresented. The quota is obviously an issue again here with for the mutual funds at least, and it's something that we will obviously realize how things move forward, because that $7 billion limit has obviously been exhausted. But what I see here is a structural shift post-pandemic. I mean, for all these years, there was enough quota available, and nobody really thought of investing into global markets until people got fearful about holding all assets in India in a black swan event scenario. So I think, again, lots of actively managed funds, but we still need to spend a few more years to figure out whether actively managed funds have been able to make a dent in terms of creating alpha. A lot more passive funds as well for large markets, but we need to see much more innovation in this field. I think investment solutions are far few and far too many of Me Too products. And maybe at some point we hope to see different styles, asset classes, and possibly the regulatory efforts around this piece may also lead us to innovate with more ideas to invest globally. I think I discussed this, and clearly it's very US dominated, or even Brazil, or even some other markets which are linked to the US economy have benefited the most in terms of flows into these kind of funds. And many investors have not really sort of. I feel, Siva, this is an area where the advisor network, the distribution networks, and even the investor education efforts need to be much more in India. It's an area where, while I select funds out, we just feel there are too many similar products from different managers across the space. So definitely, it's a sunrise area, and maybe a few more years of work on this in India will lead us to even currency overlay managers. Maybe at some point, we don't have any currency overlay managers in India on the mutual fund side of things. So I think it's good. These are innovations in asset management, and I think that we'll see significant diversification in India bias portfolios going forward. Okay, this is more academic now. So, what do I do about selecting global funds? That's the module going forward, and we look at various aspects. It's a product development for a global fund can last anywhere from 6 to 18 months. Frankly, it's no easy solution. And we think about goals, about investors in India, what really impacts them. Are they looking to sort of send money abroad with a specific purpose? Are they hedging against the currency and inflation? What are the markets? What kind of exposures they're looking for. So I think these points dominate the discussion before identifying a strategy. And then when you're looking at a list of managers, ETFs, active funds, or even building out our own strategy at some point, I think we say that let's go for the core first. Let's offer the highly liquid global markets as exposure, and then look at satellite strategies, thematic ideas with different investment horizons. This diversification, I think I always focus on two things. One is inflation hedge, the other is a hedge against India. And we all have significant wealth invested in India, and all our savings and everything is in India. I mean, why can't we just believe that once in 100 years, something definitely one needs to sort of account for that once in 100-year phenomena where you need to realize that diversification helps outside one country. So I think inflation hedged solutions, liquidity, and global macro-driven solutions seem to be sort of a good area of to think about for global investing. And then once we have these ideas in place, we start screening managers. We look at managers with capabilities, credentials, scale. If they're too large, maybe they already are not able to generate too much of alpha in those specific subsegments. If they are very boutique, do they really have the strong governance modules like for us to really deal with them? And then the fund structures as well. So I think those questions dominate. We do a lot of discussions with like, I would say at least 25, 30 asset managers at any point of time around the world. And we keep screening their strategies on various parameters, keep tracking the long-term performance, the short-term changes, just like buying a mutual fund in India. Not very different, but at the same time, trying to understand the dynamics of global markets as well. Again, so how I mentioned a few of it. We do proper screening of fund managers, the underlying teams, the fund structure, the domicile of the fund structure, taxes is important. And then, the regulations in India are very important. So there are some outbound investment regulations, and as mutual funds, we have to comply with those. So many strategies don't fall into those buckets. Nobody's really created products specific to Indian mutual funds or Indian investors. So I think, so recently we launched this product, and it was customized for Indian investors because it had only equity assets and was a hedge against inflation. So it worked very well. It was more customized for the Indian audience, but most products that we see today outside are not customized. They somehow fit into the approved bucket of investments. SEBI has some sort of restrictions on derivatives and unrated bonds and those kind of things. So I think those challenges need to be overcome if you really want to enhance the array of strategies available through the mutual fund routes. LRS is different,
Shamit,
right?
Just to interrupt on that. So, I mean, I'm looking at manager selection and so on. And do you have a view on how do what's the performance of active funds of managers who are based abroad, right? So clearly you can invest into India with research and portfolio management done outside India. How does that compare with the active management in India? Does being in India have an edge when it comes to active management? Is there anything that you have come across?
So I mean, we've come across this discussion, and the common outcome that we believe is that emerging markets have significant information, and market inefficiencies are much larger. So active management possibly works better in markets like India. Mm-hmm. Global markets like developed markets like the US or even Europe, case for passive investing is far, far stronger for traditional indices and traditional styles and strategies. But obviously, if you're looking for more sophisticated investing, we're trying to hedge or sort of diversify away from India, because a lot of investments are not true diversifiers, right? I mean, US markets are not completely uncorrelated to Indian markets or vice versa. So I think that's the kind of discussions we dominate, and passive works very well in foreign markets because they are able to execute at very low costs, and you're getting an exposure of significantly large businesses at such a low cost. So yeah, it's good to have a core.
My question is also slightly about active management. Does local managers have an edge compared to, let's say, an offshore manager? Meaning
for global strategies or for India strategies?
For India strategies. So let's say an active management.
Okay, so that's a different one. So yeah, definitely, there's no two ways about it. While you might say that most of the asset managers in India are very India-centric, right. But that brings a unique advantage to them. The large research coverage that buy-side managers would have in India is simply stunning. You wouldn't see large emerging market fund management shops having any meaningful research resources to cover beyond the large caps or a couple of mid caps. So if you're looking at small cap portfolios, mid caps, on the equity side, or even corporate bonds and the GSECs, I don't think any foreign manager has the kind of infrastructure resources, and they would never have one either because India is one part of their market. So Indian managers have an edge. I think there was a study many years back by one of the investment consultants, and they actually showed alpha being generated on a 3 to 5 year basis. This was a few years back, though. We need to retest that study as well. Indian managers outperform foreign managers for similar strategies, and only because the access to small and mid-cap stocks and even the composition of portfolios was materially different beyond the top 10 holdings, because Indian mutual funds and Indian shops are more comfortable holding stocks across the market cap and sectors, whereas foreign managers have been more purely liquidity, mega cap, and macro-driven investors. A lot of investments are top-down and not bottom-up, whereas a lot of investments in India are bottom-up and not top-down.
Understood.
There is outperformance. There is some history and study on Indian managers outperforming foreign managers.
Understood. So, we are like going a little over, but that's fine. We'll stay on for a few minutes more. I just want to kind of get out this particular issue, right? So, or the question on, IFSC. So recently, so the Prime Minister inaugurated IFSC, IFSC authority and building and whatnot. And there were also the Stock Connect, between SGX and IFSC authority. So can you talk about some of these recent developments and what does it mean for offshore funds? I know that you wanted to touch upon fund structures briefly. Maybe in the context of that, you can talk about this.
Yeah. No, I put that slide with the reason here. So since you asked me this question, but frankly, the experience shows that it takes a long time for international financial centers to become successful. We should not be driven away by near-term momentum, because you've seen financial centers in Dubai, Singapore, and even Luxembourg and Ireland. They've grown over the years. So, for example, the reason I put UCITS or AIF up here is that this is the most ideal sort of a fund domicile today, considered the gold standard for global investors. And I think the advantages they hold, possibly many of it can't be replicated in any other IFSC or any other financial center for various reasons. Obviously, one of the most important part that people forget in the conversation is, what do investors want? You remember the Madoff crisis of 2008-9 when money vanished from some of the funds. And then you remember asset managers not following investment regulations in some markets around the world. So UCITS is nothing but the mutual fund regulations within the European Union. And when you compare the IFSC, you spoke about Siva, it's not about the rule of law is important. Costs are important. Definitely taxes, costs, and all those things matter. But what matters most is how strong is your jurisdiction in terms of governance and regulations. How will you protect investors in case of any unoutward events? And most important, what do investors want commercially? If they want a fund domiciled in their home market, how does any IFSC matter to that investor? So, for example, passporting of funds, you see this on the left side of the screen. Even if you have a fund domiciled in an IFSC, a foreign regulator would not consider that fund as a retail or a marketable product in its home market. It may be available on private placement for a few groups of investors, but it really can't be publicly marketed to anyone. So I think people forget the passport idea of a fund domicile. People forget the fact that investors trust their own regulators the most. So a fund regulated by their own home regulator makes more sense to them. But again, it does not mean that funds cannot succeed. It only means that the institutional market is the first port of call for these IFSC. The retail funds and the non-NRI funds would follow over longer time periods, possibly more than 5 to 7 years from now. Once people see the rule of law being implemented in its true way on the securities market in that jurisdiction, and you see investors, being well served, and there's a stronger ecosystem for developing funds at lower costs. Once people see that, they are more comfortable with setting up a fund or buying a fund domicile, let's say, in an Indian IFSC. This is for retail and foreign clients. NRIs is different. I think NRIs would be also the first port of call for an IFSC because they'll be comfortable buying a fund domicile within the Indian jurisdiction. So I think these attributes, I think I've mentioned them earlier as well, and I wouldn't go through these slides, but Luxembourg and Ireland are now the benchmark for single country India funds, because these products are passportable across Asia, parts of Middle East, Europe, outside of UK, of course, now. But Ireland has a tax treaty with India, and these products are so well governed through the mutual fund regulations in Europe. They even have specific articles for ESG and non-ESG funds. They have limits on diversification. They have this 5, 10, 40 rule where stocks with more than 5% weight can't exceed 40% overall. So I think these kind of sort of enablers and supervision and oversight matters a lot for investors. And you can't really write off the fact that, you may have an IFSC, it's great, it's good for advisory, it's good for separate accounts, institutions maybe, but we are a long way away from foreigners directly, retail investors buying a fund domiciled in an IFSC. So it'll take its own time to develop and a lot of efforts. I'm sure it's great that it's happening. We're going to be, I think Indian asset managers see a lot of opportunities there for outbound investing as well. And so, including myself, I see personally a lot of opportunity. But, the conviction for foreign clients can take a lot more time to convince them to buy a fund domicile. I mean, simple example, Siva, today we have a mutual fund domicile in India, SEBI regulated. Why do foreign investors not simply buy our mutual funds? And how does that argument change if the fund is domiciled in an IFSC? The argument does not change at all because the same regulators, the same rule of law or similar in the same jurisdiction, right? So there is definitely a preference for local regulators, funds available in your local jurisdiction, regulated by your home regulator, and also the tried and tested model works best in this case, and that comes through experience and time. Right. So you will have to give it 5 to 10 years to evolve.
Thank you. Thank you. So we are a little over time, but I think it's been a fascinating discussion around, not just like the India story, right? So seen from a foreign investor perspective, I mean, we've been hearing India story from Indian investors for so long. So from a foreign investor perspective, how does it make sense, right? So I think I thought that part, as well as the bonds, I don't think we have covered fixed income as much in our webinars as much as we have done today. I think that's good. And I think some of the newer developments, FSC, the inclusion in bond indexes, I think that's all been excellent. So I just want to thank you, Shamit, for coming on our platform and talking about your work in such detail. And I also want to thank the attendees for patiently waiting.